Now I'll discuss the Islamic equity and what are the screening criterions. This is we generally discuss that for an equity or any investment we should be investing in permissible activities which is based on the Sharia compliance and we know there are certain industries which does not comply with the Sharia standard, as I explained you about investing in pork, invest in wine, invest in any other activity which is prohibited by Islam. We'll start our discussion with equity investment, that is through shares. We float share and stock market investor buy them and money comes to our company. This purchase shares, there are bargainings, there is so many normal trading activities involved into. There are direct investments and there are indirect investments. Indirect investment is equity market, does not necessarily need to be linked with the performance of particular stock. When buying shares through an investment in a mutual fund, the investors see benefit from the fund through dividends and capital gains resulting from an increase in net value of the fund. The fund will have invested in a diversified portfolio of shares, and the fact that a particular share gave dividends to its investors or shareholders, of which the fund will be one, will not specifically reflect the performance of the fund itself. Some investors want to invest directly in the stock exchange in terms of fund vehicles such as depository receipts and exchange traded funds. These are certain options, but in terms of investment in equity, it can be in both ways, direct or indirect. How can indirectly we can divide three categories like depository receipts, mutual funds of course, and exchange trade funds. They will be contributing to the part of the equity market. Investor will come into as a direct investor, and in terms of indirect investment, private banking, wealth managers, or via structured products, this will be managed. What is the purpose of equity investments? Of course, the first is we want to receive dividend as a distribution of the profit, benefit from any capital gain. If the share will go higher, so it will subject to a capital gain. To gain control of the company affairs, as our intention to be a major controller, to maintain a controlling interest into. These could be the possible ways, reasons. How this the Islamic equity investment is growing in terms of Sharia. There are phases. The first phase of the development is the Islamic finance industry, that is focusing on development of Islamic retail banking products, that is in compliance with the Sharia. So investment in Sharia compliant equity has become increasingly important, as with all investors. When Muslims, they have to decide whether the investment will provide a yield. Unlike other investors, they may also ensure the underlying equity are halal or haram, permissible or not permissible. So in terms of Islamic investor, you are a little bit more cautious, and therefore we should have to build and introduce an Islamic equity screening process, same way bond screening and other instrument screening. It will be having the same way core business activity screening, that what activity we are into, financial issue screening, and non-halal income screening. These are three important points which we will discuss in detail one by one. Business activity is, of course, that your activity should be halal and legitimate, and it's permissible, and So it should be Sharia compliant, of course. It gives Muslim investors a window of investment opportunities. They incline toward the investments, and they believe that the IFI is providing the Sharia compliant products. This will increase the total worth of the Islamic industry in terms of dollars. Equity of companies where main activities are non-Sharia compliance are deemed to be non-approved investments. In conventional financial institutions, they are of course based on the riba and gharar, which is not allowed. Alcohol and beverages not allowed. Gaming, gambling, and anything else, uncertainty is not allowed. Pork production not allowed. Non-halal food items not allowed. Entertainment and leisure related to pornography or any adult contents not allowed, not permissible. Armed defense and military equipment manufacture not permissible. Tobacco related products not permissible, and any other activity which can violate the Sharia, this is not permissible at all. Okay, this is the first level, and in terms of activity, the second level is the financial ratio screening. Once you pass the first step, the second step is company performance in terms of financial ratios. So companies whose interest-bearing debts divided by immediate preceding 12 months average capitalization or total assets exceeding 30 or 33%. The 12-month average is otherwise known as 12-month trailing market capitalization. This is one test. A company whose cash and interest-bearing securities divided by immediately preceding 12 months average market capitalization. Same way, a company whose cash and receivable divided by immediate 12 months market capitalization exceed 49 or 45%. So investor cannot invest in any companies because his leverage or cost of fixed debts is really high. In that case, he has to make sure about his long-term sustainability. In terms of juristics argument for financial ratio screening, the first financial ratio is the percentage of interest-bearing debts that the company has against his capitalization. This debts refer to long-term and short-term debts, and we have to see that what is the classification of that. Some scholars advocated financial ratio screening, consider current practice, and in conventional banking this is the first step to start with, to screening financially to see the viability of any investment and investors itself. Few points we have to take in consideration. One is the tolerable ratio, tolerance in terms of accommodate current market conditions by leverage, and leverage using Islamic financial products such as mudaraba, istisniya, ijara, Islamic sukuk. These all things has to be taken in considerations. When it comes to cash and interest bearing accounts, the second financial ratio relates to cash and interest bearing, that what is your cash leverage cushion to pay your in terms of your cash. This is an important ratio. Then cash and receivable to market capitalization or total asset, that is your third financial ratio. Under 2 relates to the position of cash and receivables that publicly listed companies has in proportion to their market capitalization and total assets. This is also an important consideration in terms of ratios. Level 3 screening in terms of other non-halal income generated by a company, non-core activities. How it works is, suppose if a company was to operate any core activity in one of the prohibited line of activity, its equity would be deemed non-permissible. This sometimes happens, like if you are working in liquor or some other prohibited activity, of course the income generated from that sources will not be halal. Therefore many scholars has to check, and there is a rule that is 5% rule is to screen the so-called tainted income. This means that the revenue of the company generated activity which is not approved must not be 5% or more in relation to the total revenue of the company. So this is one of the 5% rule which is acceptable in terms of certain scholars. When it comes to Malaysia, Malaysia's equity screening methodology, they take care of financial services based on the riba. They take care of gambling and gaming, and see the manufacturing or sale of non-halal product or related products, conventional insurances, entertainment activities which are not permissible according to the Sharia laws, and manufacture or sale of tobaccos, stockbroking or share trading in non-compliant security, other activity demand non-permissible according to the Sharia. In terms of SAC benchmark, we have to determine the tolerable level of mixed contribution of permissible and non-permissible, and 5% is one benchmark. Then we have another rule for 10% benchmark. This is a widespread unlawful practice, and there is 25% benchmark, that is an element of maslaha to the public. So the scholar has to decide about that what these percentages is, and how it is going to be applicable in terms of proper Sharia compliances. We should have a cleaning process. When we have a process, we should see what is the tainted income, what is the Sharia rule, do not be in consideration how long in terms of time. Only Sharia permissible equity is subject to cleansing, and cleansing of dividend in compulsory. So all this cleansing is of course is going to clean out the effect of permissible and non-permissible incomes. In terms of equity screening criteria and development of Islamic indexes, we have Dow Jones, Malaysian and FTSE indexes, which is quite popular. They have different slight variations in terms of screening process. For example, Dow Jones, they have pork, like the list of non-permissible is pork production, non-halal, alcoholic beverages, gaming, interest-based financial institution, entertainment, arms, defense. In terms of FTSE, they have almost the same tobaccos, SAP and Kuala Lumpur Sharia Index. They have certain kind of leverage, commonly is 33%, receivable 45%, cash plus interest sharing bearing is common, less than 5.55%. This is how the different comparative pictures we have for different kind of stock indexes in terms of Islamic capital markets.